Hi everybody, this is TJ with the Counter Punch Trader. We had some amazing trades throughout this week, and whether you're using the Counter Punch Xpress or the Counter Punch Trader, hopefully this video will be useful. Whether you're day trading or swing trading, Forex, futures, I want you to forget about the symbol that we're focusing on and instead focus on the strategy. And what I'll do is I'll show you what this looks like on the Counter Punch Xpress, and then we'll kind of look at it on Counter Punch Trader. You can see the differences in how it looks and feels and how you approach these trade plans in general, regardless of which one you're using. So let's see if we could accomplish that. I'm going to start off with today's Dow E-mini trade. Today is Friday, July 8th. It's the non-farm payroll day. This is an interesting day to trade. Obviously, we are a week or so removed from the big Brexit event. And a real interesting outcome, actually almost 2 weeks removed. Now that I look at the calendar, time flies. And there's been some amazing movement in the markets. It's like, for us, that's kind of what the markets needed to give us a reason for it to get volatile. And volatility is always good for us as traders. So whether it goes up or down, we don't care as long as we get good movement. So I wanted to look at the YM today because the YM, you may or may not know, uses a particular way of using the counterpunch called trend mode. And what trend mode means is that we add an additional level of confirmation. It's a 20 simple moving average, and very simply, when it's up, we can take long trades, but not short trades. And when it's down, we can take short trades, but not long trades. We also can get in sync with the trade. Okay, getting in sync is an important concept with the counterpunch because sometimes the conditions will change and the setup that was being filtered out all of a sudden becomes a valid setup. We're going to look at that on this first example. You'll see exactly what I mean. Okay, so we start trading the Dow E-mini at 8:30 Central Time, exchange time, which is 9:30 when the market's open. So let's just click through and see what happens. So here we are. There's a setup, and it's about 10 minutes before our start time. It's a long trade. This blue line is a simple moving average, and it is down. You could visually see it, and for that reason, that's a trade that you would not take, at least at this point. Plus, it's 10 minutes early. So let's just keep going and getting closer to our start time, not quite there, until we get to this level right there. And at 8:30, it looks like it's a little bit above the entry. It does stab down on the next bar and gives you a chance to grab the entry right there. The only thing is that the moving average is still down. And you could tell because when you click on each bar, you could see that it's going lower from 0.55 to 0.5. By the time it stabs down, it's lower, right? It's based on when it closes on the prior bar. Can't do it intra-bar if it happens to tick up when the bar is forming because there's no way to backtest that. So you do it based on the bar that closes. And so it kind of takes off, and we can't take that trade because the filter's still down. A down, simple 20 moving average means no long trades. All right? But the concept of getting in sync is that if a trade is triggered in, as long as it hasn't hit its money management level, which is typically at the first target, depending on the trade plan, it might also have to go 10 ticks or 10 points, like in the case of the YM. If it hasn't hit its stop, and then it comes back down, we could still take the entry. That's called getting in sync. Okay? And what happens is, and this is important because obviously as you're learning the counterpunch and the Counter Punch Xpress, this is one of those rules that makes a difference, and it may take you a little bit of time as you go through your training to actually get to this point where you're even thinking about this little way of doing things with these situations, okay? So that's why I thought I'd start with this video and call it to your attention. A lot of you are going to maybe get discouraged before you really understand how to use the strategy. And that would be kind of sad, because the strategy is extremely profitable if you know how to use it properly. So look what happens. Notice that the SMA is moving higher now, but so is the price. It hasn't come down yet, but ultimately it stabs down. Now there's another concept that we use, which is called the chase concept. This is something that we added to the Counter Punch, I don't know, maybe a year after it's been out, just from lots of examples and learning how to better use it with tons of repetition in the trade room and seeing these examples. What the chase idea is that if your price is above your entry and you're hoping to catch a pullback, like it's pulling back here, right? You can adjust your entry up a couple ticks. So instead of getting long at 31, you would get long at 33. Now, sometimes it'll go all the way down to 31, and you give up 2 ticks because you could have got long at 31, but instead you got long at 33. But this also will protect you if it doesn't quite get to 31, and you could still get into the trade. A 1 or 2 tick adjustment is acceptable in most cases. Okay, this is called the 2 or 3% art to trading. And in this case, it was appropriate because it does stab down to 33. And at that point, it had already started moving higher, the SMA filter, and you could get long on that setup on this bar as it pulls back. Remember, you can get in sync if it hasn't hit money management, if it hasn't stopped out, and the filter conditioning changed. The declining SMA started to go up. This is called trend mode, and this is why we do this. Okay, so look what happens. It would have hit the entry anyway. So, if you chase it or not, that's a stylistic decision. You can decide to do that. You can think about it. Throw it into your back testing. I personally think it's a good idea. I don't mind giving up 2 ticks to get into a nice trade that's going to go from 31 up to 64. Right? That's a 33-point move to target 2. 2 ticks, I could do that. In this case, it wasn't necessary. But look what happens. So you get long regardless, whether you chase it up to 33 or you get in when it pulls down to 31. This is the first trade of the day per the trade plan. And look what happens. You have a short trade right here. But you know what? The SMA is long. So this is not a trade. You have to filter that out and ignore it. You want to keep track of it if the conditions change. But notice it stabs down through this entry. It even goes 2 ticks beyond, which would be our stop and reverse adjustment to get short. But because the SMA is up, we ignore it. This is what trend mode does for us. It filters stuff out. Here's another trade, right? But look at how the SMA is still moving higher. You cannot take short trades, so you stay long. You stay long. Comes down even further. You might feel like you're under pressure. Uh-oh, should I cancel the trade? Should I use these filtered out trades as a quick exit? Should I be afraid of the trade? My stop is down here for a reason. All of a sudden, the price pushes higher, pushes up. And if you're, thinking, well, maybe I should take this trade if you didn't take that trade, I could understand that. And maybe it's going to work, maybe it isn't. But that would be a mistake if you're committed to this trade plan. Okay, trade planning is very important. There's a reason we use trade plans. The Counter Punch is not just any random trade. The Counter Punch is also trade plans, rules, what trades we take, what trades we don't take, right? This is a tactical approach, but the overall strategy is to treat our trading like a business and to run it consistently and correctly each and every time. This is why I'm such a stickler and try to teach you guys how to fast test, back test, build your foundation, and know what you're doing before you risk real money. It's worth learning this. Trust me, it is. Look what happens. Still wiggling around. And now this is down. But it ultimately pushes higher. Very choppy in here. Okay. These trades, you might think, well, gee, didn't the SMA come down? Can't you now, aren't you supposed to take these trades? Well, the thing is that these trades canceled because they would have stopped and reversed to long anyway right here. But also you're in the chop zone and you can't short when you're above the 50 EMA. These trades are canceled by for a variety of reasons if you know the rules. Basically, you're still long on the purple trade if you're doing this right. It comes up. Ultimately, it's going to move higher. If you took the green trade, you're still in a good position because it ends up hitting target 1. It's kind of hard to break this if you really understand it, but the purple trade was the correct trade for all the reasons I said. The green trade worked perfect also. The purple trade hit its target right there. Either one of these trades end up working, and you end up with a one and done session with power of quitting. Yeah, of course, the trade's not over. If you have multiple positions, you would be trailing the signal line, and it doesn't quite get high enough and ends up stopping out right here. Still for a really nice trade, one and done, to finish your week with the Dow E-mini. Now, how does this look on the regular counterpunch? Because I'm sure a lot of you might be wondering. Let's go back. Let's take a look at it one more time. We'll talk through it. So I'm going to turn off CPT, which is basically the counterpunch stripped down to its basics. If you have the Counterpunch Trader, you can just have it look just like Counter Punch Xpress if you want. And then we'll put on the full version of the strategy with this trade plan, with trade tracking, with everything. Okay, trade tracking can be confusing because you start seeing the trailing stops. Whoops, let me turn off the Counter Punch Xpress Calc 2. All right, key level adjustments, things like that. So let me just see. All right, here we go. I want to put the moving average on there, the Counterpunch Trader moving average. It's a little bit more enhanced, a little bit more helpful. Counterpunch Trader comes with an enhanced version of the 20 SMA where it's red when it's down and blue when it's up, and the visual is very useful. So notice the purple trade that we were looking at earlier at 8:19 and 54 seconds, right? 10 minutes before the open. On the Counterpunch Trader, it's filtered out. Remember, we couldn't take it right away because the moving average was down. So the Counterpunch Trader knows this. With Counterpunch Xpress, you have to use your brain and think it through, which I personally think is the best way to learn the strategy. But once you learn the strategy, the convenience of the Counterpunch Trader really starts to show its merit. Okay, there's a lot of programming in here. Look at how the entry now has moved up to 33, right? And also notice that the moving average turned blue because it's starting to move higher. That's because inside the Counterpunch Trader, there's a setting that we can literally use if we want. It's optional to chase this up 2 ticks or as many ticks as we want. Okay, 2 is a typical number I use. So you could either do it in your head and just know that you're going to put your entry in at 33, but the calculator, notice that the trade reprints the exact targets, exact everything, because the conditions changed and the calculator knows you can get in sync with this trade. It knew to chase the entry up because we set that up in the calculator. So when it stabs back down right here, look at the arrow. That's the arrow I showed you earlier. See? You're long on that trade. Here's the filtered out trade we looked at, the short trade. The calculator knows it's up. The moving average is up. We can't take it. Here's the second one. That was that green trade, that bright green trade, right? It also knows it's filtered out. That's why it's in gray. Because trend mode is up, you can't take shorts. Notice that it also knows that the stop is down here and it continues to track across the bottom because we're using the trade tracking tool that the Counter Punch Trader has. You can turn it on or off. Remember the second green trade I showed you? Well, the Counter Punch Trader knows it's an add-on trade. That's why it's dark green, you see? Because it knows that this is the primary trade. Now, there may be a time when you actually do take an add-on trade, depending on the trade plan. This might be the first trade of the day, we would take it. But in this case, we're already in the purple trade for all the reasons I explained. Notice that none of these trades come back, even though, well, the condition's still up, so you would already see that, they're still filtered out. But the calculator knows. Calculator doesn't know it would have got long in this green trade because it's still tracking the purple trade. Okay, so, but it shows you this trade, and it chased, let's see, oh, I see, this is a new setup. It gives you a new setup because of these dots right here. So these trades canceled, you got a new setup, it's below the 50, so the calculator shows it, right? If it was above the 50, it would be filtered out because you're in the chop zone. But at that point, it doesn't matter. It doesn't matter because the price is moving higher and does exactly what I showed you. Ends up coming up and hitting targets. You can see the trailer beginning to trail. The stop moved up from here to here to lock in profit once it hit target 1. That's the money management level. That's when you would no longer get in sync with this purple trade. I mean, really, with all these bars in here, you have a chance to get this long trade, right? You have plenty of opportunities to get on board that. And then it comes up, of course, and ultimately stops out right there. Whether you're trading CPX or CPT, it's the exact same trade. It's just a matter of knowing the rules and knowing how to use the strategy. Yeah, there are a lot of dots here, and it could be confusing. The trick is knowing when you're starting and then staying in sequence and just thinking it through click by click. Eventually, the more you do it, the easier it's going to be. And remember, the CPT shows you a lot more dots and how much cleaner and easier it was to look at with the CPX. Just give you a quick reminder. The CPX definitely has its merits because the chart is very clean and it forces you to learn the strategy properly. So yeah, you still see the exhaustion dots. The reason they are these colors is because you train your eye to not think that they are targets or anything you have to think about in regards to the trade. Until you're in the trade, you know that the dots that correspond to the trade are typically your stops, depending on if you're making an adjustment around a key level. All right, so before I finish this, let me show you the UTA spreadsheet. I've been tracking this particular trade plan for 2 straight years, basically. And, from the middle of the summer of 2015, actually the middle of the summer of 2014, all the way through now to the middle of summer of 2016. And this is today's trade. You can see there's your 31-point target 2 that we just looked at. I track all 4 targets on my spreadsheet. So when I put in a trade, I'm putting in 4 trades because I want to get information on how each one of these targets perform. If I'm going to target 3, notice that target 3 is less than target 2, and you might think, well, why is that? Well, it never got to target 3, right? It stopped out with the trailer. So sometimes the target 3 will be achieved, like in this case, and then the trailer picks up more. Other times it won't make it. It'll just be a partial profit. And when you look at that over a lot of trades, you start to get statistics. Okay, and that's the reason why I like to track them all, because then that helps me decide, well, with this particular chart, what's better? Maybe just trading to target 1 is good enough. I've seen that on occasion. Maybe target 2 with a single position is a great way to start if you're just beginning. But if you want to add a second position, is it better to go to target 3 and just take that bigger fixed target all the time? Or is it better to hang on to a trailer for the home run trade? And if you track your trades, you're going to get that detail and be able to make those decisions. Remember, you want to think like a business person. and get the information you need to make the best choices for you and your trading business. Don't just be some person trying to trade, all right? If you have been doing this, you would know that it's kind of been a tough year. This is dating back to mid-March. You could see that it's been going up, 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 but on occasion, there's some steep drawdowns. Okay, you can clean this up. Remember, this is 4 positions. A single position is not going to look so dramatic, for one thing. Another thing is you could take fewer trades. You can analyze your results and see maybe fewer trades will give you a higher average net profit per trade, right? How much do you make per trade when you factor in all wins and losses? The higher number is obviously the best number, and that's usually what tells you how many trades you should be taking in the first place in a given trade plan. But there's no way to know that if you don't build your spreadsheet and build your foundation. What's really interesting, you got some stability graphs over here, and what this shows you is what the running weekly moving average is for winners, right? Your winning percentage. And each one of these diamonds here shows you a week's worth of winnings. And you can see that most of the time the weeks are ending positive. They're above the line. And the times that the weeks end negative, it's just a little bit below the line. You see? So on average, your winning weeks are a lot stronger than your losing weeks. And there's more of them. That tells you a robust strategy, doesn't it? Same with the profit factor. Look at how this curve is pretty much straight across. That's pretty stable. When you see lines going straight across like this, you got to get, 100, 150 trades into your spreadsheet, and you you start getting stability in your statistics. But what's really interesting, like if you look at this profit curve, this profit factor curve, it's pretty steady going from left to right, so that's stable. But notice that on the winning weeks, the profit factor is pretty high. I mean, you have some 4.0 profit factors. But look at when you get below the line on the losing weeks. The profit factor is not that bad. It's just a little bit below that moving average, that profit curve. That's a rolling moving average. Okay? These are the things I like to look at when I'm deciding what's worth trading. Okay? How many of you have bothered to look at information like this and make trade decisions based on this level of knowledge? Makes sense, doesn't it? Remember, if you're the CEO of your trading business, it's kind of your responsibility to have the best information you could possibly have so that you can make the best decisions for the growth and long-term prosperity of your business. It's a different way of thinking. Human beings make terrible traders. We're afraid. We're constantly trying to survive, basically. Your instinct for survival, you get in your own way and sabotage yourself. But if you can get to that point where you're thinking trade plan, long-term statistical advantage, putting very small risk on each trade so that when the losers do come, and they will, you can survive. But you let the power of the odds work in your favor, eventually you grow your equity to where you can now increase your position. A bigger position means faster growth, which then leads to even faster growth and even faster growth. So 2 years from now, you hit an exponential curve and you're trading a large position, but it's still a very small percentage of your capital. That's thinking like the CEO of a trading business. That's the kind of strategy you're going to want to employ if you hope to succeed as a trader. Okay? And there are ways to get there. Follow the steps to the success guide. And we talk about this all the time in the trade room. The last curve I'm going to show you is the expectancy curve, the average net profit per trade. You can see that, it wasn't very good. It even got down to almost zero. And if you look even further back, the beginning of the year, it kind of went up and then down to here, and this is where the growth really started, because the first 3 months of the year are typically very difficult for the E-minis in general. All right, so even the first 4 months. But notice that the average net profit per trade has been steadily growing up, getting higher and higher. And notice that the strong winning weeks are much stronger than the losing weeks. Again, this is showing you stability. Remember, this is looking at 4 positions, so you have to always remember that. So the point is that whether you're looking at the DAX or whether you're looking at any market, the first and foremost thing is you have to think like a business person, and you have to understand your strategy. Now, I was going to talk to you and show you some other markets and some other charts, but now I see that this video's become pretty long, but it's thorough. And I wanted you to see this because you can apply this. This is trend mode. It works on a lot of great markets, and I'll do another video with some other examples. So I hope you enjoyed this, everybody. This is TJ. Have a great weekend, and I'll see you on the next one.